The RWA space is evolving faster than ever. The world is watching as tokenized moves from concept to implementation, with institutions, innovators, and regulators all stepping in to shape its path. At the same time, industry leaders are urging caution, reminding us that while RWA momentum is undeniable, sustainable growth depends on real assets, real liquidity, and verifiable value. That's exactly what tonight is about. The individuals you will hear from represent some of the biggest movers and disruptors defining the RWA space today. These two panels bring together the voices of leadership and are actively paving the future for real-world asset tokenization. So let's dive in. It's going to be an insightful, forward-looking conversation about what's next for tokenization, trust, and transformation. Now, I'm going to introduce our first panel. This is Tokenizing the World. Our first panel will dive into how traditional assets, from real estate and commodities to funds and equity, are being brought on chain in secure, compliant ways that unlock global access and liquidity. So please welcome our moderator, Cade Bergman, host of Wolf Financial, one of the largest influencers in the space, with over 440,000 followers on Twitter and X, and our incredible panelists are as follows. So we have Jonathan Espinoza, Director of Investments at Securitize. We have Benedict Shipley, co-founder of Obligate. We have Shanahan Kostafin, General Partner at DPI Capital. Jai Bufuko, Chief Commercial Officer at Kinesis Money. Uber. We have Uber Havid, co-founder and CEO of Nomyx. And then we have Matt Nicosia, who is our co-creator of Trust the Smart Chain. Okay, the stage is yours.
Yeah, it's good to see everybody here. Thank you all for coming. My name is Cade. I'm representing from Wolf Financial and Wolf Bitcoin. We host some of the biggest spaces in the world for Bitcoin, as well as everything going on in digital asset landscape and trading and all the things. And so I'm excited to jump into this one. We've got some amazing people up on the panel. And it looks like we've one final chair here as well. Alrighty. So very excited to get into this conversation. The RWA world is absolutely taking off. Ton of interest, ton of institutional players here as well. We have all sorts of shows on X and Spaces and stuff where we really dive into these conversations. And so very cool to be joined by all the people here on the panel. So kind of like a broad question here to start. I am curious on what you guys think about this from like the business side of things with the business model shift. And I'm curious on what you guys think will signal like the tipping point, I guess, for RWAs we have greater retail access. There's also lower fees, embedded DeFi and TradFi flows. It depends on what aspect of the industry you're going to be focusing on, I guess. And so maybe it'll depend a little bit on your business model that you guys are focusing on. So if you guys could maybe take a couple sentences here as well to introduce what your company is, because I'm sure that will affect the answer you guys have for the area in the industry you guys want to take over. So we'll just go in order here, just down here, and we'll spend 30 seconds a minute on each person so we can have some good back and forth since we can have a conversation here.
Testing, there we go. I'm Jonathan with Securitize, and what we're focusing on is really tokenizing the world. And so what that means for us, our next phase of growth here is looking at tokenizing public equities. And so to date, our company is really focused on tokenizing private equities. And so we're really making that shift to the public market to get access to more retail, and also make it more interoperable with DeFi. And so that's really where we're looking at for the next few years.
Hi everybody, my name is Benedict. I'm a co-founder of Obligate. We're a startup based out of Switzerland, and we've been doing blockchain-based capital markets since about 5-6 years. And we've been focusing on private markets in particular, and on the debt capital market side of things. We've brought a ton of asset managers on chain, traditional financial institutions which would not have touched blockchain technology a few years ago, and today they issue bonds and derivatives natively on-chain on the Obligate infrastructure. And so yeah, it's an amazing time to be in a space and see how everything has really evolved.
Hey guys, my name's Shahan Kashafian, General Partner at DPI Capital. We started as a Bitcoin-focused VC fund, and just recently we have added to those efforts, and we're doing digital asset management, specifically taking unproductive assets like real-world assets and bringing them into the crypto world and the DeFi world. So think of us as a partner that these traditional finance companies work with to explore this space, to get into this space, and to deploy that capital and those tokens. So very nice to meet you all.
Hi everybody, Jai Bafulko here, Chief Commercial Officer of Kinesis. We tokenize precious metals, physical precious metals. We've got infrastructure that spans the globe. We're moving into tokenized real world assets. We've been in it for a decade now, and we're now moving into stablecoin. So yeah, there's a lot to unpack, and I'm here and looking forward to the panel.
Hey guys, hey guys, my name is Ver Javed. I'm the CEO and co-founder of Nomyx. Our focus is providing traditional asset managers with a framework that allows them to seamlessly transition to blockchain technology, with that while hiding away and abstracting away all the friction points that are typically associated with blockchain. We don't say the B word, the C word. It just happens to run on blockchain infrastructure, but it looks, feels, and smells like a typical brokerage account. Our typical focus has been on yield-bearing assets, so think evergreen funds, private credit, and we've started segmenting into areas such as pre-IPO securities with SPVs. Excited to share this panel.
Hey everyone, Matt Nicosia, the co-founder of Trusted Smart Chain. Trusted Smart Chain was built to add the opportunity from a community level to participate in real-world assets and a structure around the we'll call it the contract level, the blockchain level, to focus on, we'll call them smaller assets under $1 billion in market cap, but where community can be built. But give them a clear framework, a regulatory framework that's actually instilled at the smart contract level, such as regulatory filings, KYCs on both, and KYBs on the companies, the officers, the directors, the auditors, the attorneys, trying to bring that truth and transparency to the crypto sector, but enabling for smaller companies, enabling investors who want to dabble in the alternative asset sector into something that has transparency, whereas today it has not.
Very nice. All right, we got some intros down. And so one of the craziest things I've seen in the space has been the flip-flop from people like Larry Fink, and we talk about this in all sorts of spaces in the tokenization world. Larry Fink, CEO of BlackRock, big-time player, also advisor to like basically everybody on earth who's interested in making money. And so that's a big time change. And probably us on the panels, we've probably talked about this at length now with Larry Fink. We've also seen the tokenization from all assets on Robinhood. Vlad Tenoff really putting a big focus, and some of the companies we work with as well. People want these assets tokenized. They want the ability to trade things on chain 24/7, permissionless a lot of times. And they're saying, hey, why am I waiting for the market to open? I'd rather hold these things in my own wallet. And all these things become possible when you're bringing these things on chain. So I think it's really cool. And so you can start here. You know, we kind of opened the conversation up, just getting some introductions from everybody here. But also, you know, from a business model side, I'm curious what you guys think is the most exciting thing. We've seen the tokenized assets really take off from Vlad. And I'd argue that's probably the biggest headline that I've seen from the RWA world. But you guys are on the ground floor. You guys are building in these worlds. You guys are also in all the meetings and stuff too. And so I'm curious on what you guys think is the most exciting. And if you guys, you know, if you think your business model makes sense into that answer as well, you know, definitely insert that into the answer because it makes sense. But you know, if you want to speak more broadly as well, or if you want to speak on more of a broader stage, that also works. We'll try to keep these takes to 1 to 2 minutes, just because we have a good amount of people here on stage. But I'll start with you.
Yeah, so generally, I agree with Vlad from Robinhood, right? So they're tokenizing equities. We think that's the future as well, but there's a right way and a wrong way to do this. So a lot of companies are doing this quickly, speed to market, but they're doing it the wrong way. And what I mean by that is they're tokenizing some SPV that buys the equities, and so as the investor, you don't know who you're facing, there's counterparty risk. And so Securitize, because we're the largest RWA company in the world, we are looking to do this the right way. And what I mean by that is we're looking to tokenize these equities using traditional transfer agents that are okay using blockchain as a ledger. And so you have the shares of stock both trading traditionally, like you would, you know, in your Schwab account, let's say, and also on blockchain, and you retain the same rights as the investor. So that's the way we're trying to do it. It's a tough nut to crack because there's a lot of incumbents out there, and so we'll probably see this happening sometime next year.
Yeah, thank you very much, Jonathan. Actually, I'm very much siding with you here, and I think it's a very important point you bring up, and I don't think it's talked about enough in the space, and that is the difference between tokenizing existing assets that have been issued on a TradFi infrastructure using all of the traditional intermediaries and actually doing native on-chain tokenization, issuing an asset natively on-chain. It doesn't exist in the TradFi world, but it's actually still relevant from a legal perspective. It's regulatory compliant and is transferable and recognized as this main asset. And the main point why that's such an important difference is the actual profitability, the business model you can build around it. Because a lot of companies have been very successful, and also, what Securitize has done with Biddle and BlackRock was super exciting, bringing these assets on chain. You can create access to it, 24/7 tradability. People who previously may not have had access to these US-based securities gain access. But how many basis points can you actually earn on an asset that's already accessible to every investor in the TradFi infrastructure and ecosystem, right? And so what we've been focusing on with Obligate is really doing everything natively on-chain. So bonds are issued natively on-chain by traditional companies, and they do that because you don't need a paying agent anymore, no issuer agent, no central securities depository. Everything is done on-chain, and we have a programmable asset. That is the bond issued natively on-chain. And the actual money we can earn that's not just a few basis points. We get up to like 100, 150 basis points that we can earn because we also actually automate the legal documentation. I'm a lawyer by training, so that's where a lot of the value capture is actually to be had, and the rating side as well. So that's something I think where we need to have like a more honest discussion about the profitability of these business models. Yeah.
Real quick, just before you go, because I think we also have multiple people in the panel, so we might just step on each other's toes a little bit, but just to throw in an extra thing there. I've heard, it's kind of like a hot take I've seen on X, and they say, this obsession with billions becoming tokenized. I'm glad you said, because there are assets that are already on that you're not tokenizing, and then there's natively bringing on from like a first principles and first starting on chain. I'm curious if you think that the phrase "bring billions on chain," if that is a net positive type of line to throw out there. It's the same question with Bitcoin. Like, Bitcoin is going to 1 million. Like, is that really something we need to be putting out there all the time? Do you think it makes sense to keep going on with that? So I'll throw that in there a little bit as well. But if you wanted to take on that question, or if you want to add on to that.
Yeah, I think it is a net positive. Even Bitcoin getting to 1 million is a net positive. The way I kind of think through this is, first one is take a step back. There is physical, real-world assets, or the traditional finance, and then there's the decentralized world. And I think one of the keys to kind of unlock here as you think about this is, what are the net benefits of bringing these things on-chain? Does it need to be on-chain? When there is that disconnect between the real-world asset and something on-chain, there's a lot of problems that are created, right? Like, you might not, the synthetic asset might not have the same value as the real-world asset, and there are discrepancies there. So I think bringing these things on-chain is important, and obviously building up that TVL is really important, but only if it's done in the right way. Because think about what happens when you create a real-world asset within crypto. Well, in the real-world asset world, there's certain things that you can do, and you have certain limitations. But when you move into the crypto world, there's many things that are unlocked. For example, you can create liquidity pools. There's yield opportunities. There's lending on-chain. There's all these different interesting things you could do from a DeFi perspective to loop yield and do different lending strategies with the yield. And so as you do bring these things on-chain, I think the thing to think about is, what is actually being unlocked when I do this? And if you don't have a good strategy and a good roadmap as to how you're going to do that and how you're going to create a really good product and token on-chain, then it's maybe not a good idea, or you need to work with a partner. And that's typically what we do when we engage with different clients, is we think through the roadmap of creating a foundation, creating different partners, creating demand for this token, both at the chain level as well as at the dApp level, to really make this useful.
Yeah, and building on that, from our perspective, with tokenized precious metals, bringing sound money into the RWA game and working with partners much like Shahan is key for us, because it brings yield to otherwise non-yield bearing assets. So the DeFi space is unlocking what has previously been unachievable and is now creating a lot of excitement for us particularly. And Yeah, we're moving into stablecoin as well. You start to bring precious metals and stablecoin into this sphere. The TradFi space, the DeFi space, it's starting to converge. A lot of sophistication is coming in, and the partnerships and sophistication of partners is next level. It's maturing really, really fast.
Right. I'd kind of like to go back to what Jonathan said earlier, that there's a right way of doing things and then a wrong way of doing things. The reason I think that for the most part that Kraken tokenizing securities and Robinhood tokenizing securities isn't really true tokenization. Why? It's an IOU on their platform that is custodial. You can never take it anywhere. It can never actually move to another platform. If anyone of you've ever tried to move a 401k from one provider to another, you'll understand the pain that you have to go through with dealing with proprietary funds. These tokenization initiatives are exactly the same thing, right? They're an IOU on their balance sheet. Now, why? The question that we asked earlier is, why do you actually want to tokenize something? What are you actually unlocking from it? One of the fundamental benefits of tokenizing private markets would be the ability to actually, if it's rated, especially if it's a yield-bearing asset. This is especially true if it's actually generating a certain amount of yield. For example, it's a bond or something like that that's tokenized on the Obligate platform. The ability to take it to a rating agency like Particular or S&P Global 500, getting it rated, taking it to a platform like Euler or Aave Horizon, collateralizing it for 30, 40, 50% of the LTV, and hopefully the yield is actually paying off a significant portion of that loan that you're paying. You can actually free up immediate liquidity to be a little bit more opportunistic in your investments. One of the primary reasons why people don't make a higher allocation into private market segment is the lack of liquidity, because I have to see it out through maturity. If I'm locked into a fund that's going to go for 3, 5, 7 years, if I try and get out of it earlier, firstly, I've got to go and beg and plead with the GP to let me out. Then I've got to I'm going to get bent over a barrel and they're going to offer me 60 to 70% on my net asset value. Then the broker's going to take their 5%. Then Uncle Sam's going to take his 20%. And I've just left for 50% off my paper value anyways. So wouldn't it be better if I could just collateralize it, still maintain the upside of that asset, but still get that liquidity that I need? That is one of the primary unlocks in private market segment from tokenizing. And unless you're unlocking that, or one of the other tangible benefits that my esteemed panelists mentioned earlier, there's really no point in tokenization.
Real quick, actually, you mentioned S&P Global Ratings. So I believe they gave MSTR strategy a B or B minus or something. So my question is, A, like, do you agree with that? B, do you think they understand? I actually spoke with someone who was from there, and I was just trying to get a gauge on where he was at with Bitcoin and crypto and all these things. And it was a bit of a hazy. I couldn't fully see if they got it.
So there's two divisions in the S&P Global 500, right? There's the traditional business, and then there's the digital asset division. Now, the digital asset division has like 5 people in it, right? So, but the different thing about the S&P Global 500 digital rating is they're not actually rating a crypto space. What they're trying to do is they're rating the products that they've always rated for the past 3, 4, 5 decades, with the added section of your counterparty risk, your bankruptcy, remote protections, things along those lines. There's just additional things to consider. So I think to some extent they do understand the RWA space significantly better than the crypto space. And as far as MSTR is considered, this is somewhat of a contrarian view, but I think one of the biggest institutional risks to Bitcoin is Michael Saylor, because if he gets unwound, that's going to be a dangerous day. Yeah.
Going back to the original question about tokenizing, we'll call it, or wrapping current U.S. equities and putting them on other platforms. From personal experience from someone who's taken companies NASDAQ myself, and dealing with all the settlements, dealing with checking my NOBOs, my OBOs, my DTCs, and my Bloombergs, and finding out where all the hypothecation is. To me, if you're taking a U.S. asset, you're wrapping it somewhere else, which is a good point, because especially if it's on chain with settlement, there's less of the manipulation that happens in the U.S. equities markets. U.S. equities markets, 85% of all stock on NASDAQ is traded in the dark pool. For those of you that haven't run a NASDAQ company that deals with that, it is awful. One of the main reasons I did this, I'm done. I am so done. So that's a good thing. But still, to me, because there is the underlying manipulation of the US equities market, now you're just doing overseas ownership on-chain, there's more fundamental change that need to happen. Yes, there's great liquidity. The US NASDAQ loves to say how much liquidity they have. We are the most liquid markets in the world, which is great if you're in traditional finance or TradFi, but if you're a business builder or you're a person who hears a story and buys the stock, it's really sad to know that, listen, the day trading algorithmic guys that are in and out, they need that. For the fundamentalists, which some argue there shouldn't be any more fundamentalist investors, but to buy a company on even MicroStrategy, for instance, I believe it's going to go to $1 million in Bitcoin. I'm going to buy and I'm going to hold. For the original way the US equity markets were built to encourage capital formation, it kind of goes against with all the manipulation we currently have right now. So I think it's a good step in the right direction, but there's more that needs to be done for the capital formation to have a success versus what's happening in the current markets.
I like this. By the way, if anyone else wants to jump in on this last couple of points, feel free to. I have a couple of follow-ups as well, but if anyone else wants to jump in on this, please do.
I don't know if this is on. Check. Yeah. So I agree with the Michael Saylor point you made. I actually spoke on a panel in DC, BTC in DC recently, and it was about Bitcoin treasuries. And my take on it with Michael Saylor in particular is Michael Saylor can have the damaging effect that we all think he can have, right? Because he is a huge voice. He's fantastic at speaking. He's an amazing evangelist. However, he's getting up to 5, 6, 7% of the Bitcoin supply. I actually think the risk on that piece is actually the BTC treasuries that are second-tier treasuries, right? They don't have the Michael Saylor. So if the Bitcoin price goes down, how are they going to raise money? How are they going to keep the interest high? And so when those second-tier Bitcoin reserves go down, I mean, that has a higher likelihood, in my opinion, to have cascading effects across the industry. And I think that goes for a lot of the other treasury companies, whether it's RWAs, other crypto assets, that you have to think about is like, how can you deal with the bear market? How can you deal with continued interest? What are you going to do to continue to keep those users sticky? Because in this space, you will find, whether it's RWAs, whether it's stablecoins, maybe if it's gold and stablecoin with Kinesis, it's a different story, but it becomes really difficult to keep those users sticky and happy because they just want out of crypto. When you have an FTX type of collapse, no one wants to touch anything near crypto. Doesn't matter how good you are. So I think the real risk is actually the second tier assets, digital asset management companies, and those sorts of companies.
The second tier treasuries, with both SBET being a prime example of it, which it pumped up suddenly and then it collapsed like 50 to 60%. The challenge that I have with even tier 1 or tier 2 treasuries, I don't really care. MSTR was great back in the day, 5, 6 years ago, 4 years ago, 3 years ago, when you didn't have ETFs that gave you direct correlation, when you didn't have the FBTCs, the IBITs. I, for some reason, can't justify the premium that we're paying on top of the net asset value with any of these treasuries companies. I'd love to buy them if they're below NAV. And Robinhood stock was a great play at the start of 2023, where their net asset value was about 20%. Their market cap was about 20% lower than their Bitcoin holdings, which was great. Like, that was a great trade. But when you've got a premium of over 30, 40, 50, sometimes 60% on their actual net asset holdings, it makes zero sense. Why would you want to go into that when you can either buy and hold Bitcoin directly yourself? It's getting easier now. You can have Coinbase, Kraken. There's a million different exchanges. Or if you just want to buy it in your 401k, you don't want to deal with crypto, you can just buy FBIT and IBIT or FBTC. So, I mean, he's a great orator. He's a great evangelist, so he can raise a lot of money. But outside of that, I can't justify the premium, at least to myself.
Yeah, I would agree with that. I think that there's a huge premium, but Michael Saylor is the only one with the mouthpiece that could survive.
It's speculation. It's speculation on a very speculative asset. So it's speculation squared.
Yeah, so he can expand the opportunity, right? So like, you have something, you see something in front of you, but that guy's mouthpiece gets in front of cameras and he's able to expand the opportunity. Of course, the risks are there, just like they are with the second-tier companies, but your ability to raise capital and to continue the interest and to continue to evangelize is going to be a direct correlation to how much you can keep people's interest into these things. I agree with all, I mean, I want to look under the hood of like how all this stuff is being done, but I would say if there's anyone that can get through those, even if it's overinflated to infinity, I mean, he's probably the guy, not to say it's healthy or any of those things, but there's not every one of these companies has that kind of evangelist that's leading the charge.
But I also think it's a bit of a distraction, you know, like all these digital asset treasury companies coming into the market, and maybe they're creating access to certain types of, you know, crypto currencies that some TradFi investors don't have access to. But it's not really a technological innovation. It's not really disruption at all. And again, if we then have the market risk compounding, it can lead to the actual true story taking a few steps back again. And the true story is we're currently changing the infrastructure of the entire financial system. And Bitcoin has a big market cap, it's a few trillion. But the value behind the global financial system, the actual rails, the plumbing we're doing, that's likely much bigger. And that's what we're all working on, right? And I find it such an exciting time to be in a space, because previously you could feel that when the markets were turning towards a bear market, et cetera, things got a bit choppy, then the advocation of digital assets and tokenization was pushed back a few years, right? 2018, everybody was talking about tokenized securities, et cetera. But it never got actually a hold because we didn't have the infrastructure, we didn't have all the linking pieces. We have that now. And the exciting thing that I see in the space is even if the markets are choppy, even if we're going to enter into a bear market now, tokenization is here to stay because the pipes are being laid and we have players like BlackRock, we have all the globally relevant financial institutions which have started adopting the technology and not just doing POCs, actually using them in their business. And that's why, you know, I think the more focus we can put on that, the more sustainable it's going to be for the entire space.
Could I add one point? Yeah, go ahead.
Just one last thing on Bitcoin. No one is tokenizing on Bitcoin, really. Like, there's a massive opportunity, I think, to figure that out. Like, most of the tokenization is happening on Ethereum, other L2s. So as much as we all love Bitcoin and are probably hodling up here, like there's a big opportunity for someone to figure out how do we actually tokenize Bitcoin. And there are some L2s that are trying to do it, but it hasn't happened yet. So I think there's still a big opportunity to maybe pump the price up way higher.
Yeah, so actually our first Bitcoin-focused VC fund is creating the application on the L1 layer for Bitcoin. It's called Arch Network. You could check it out. They have a really innovative solution to do that. The one thing I would say, like, we don't want to decouple RWAs with crypto too much, because if you look at liquidity pools, you're bonded with these assets. So you're going to move together. I mean, a lot of the reason why crypto moves in sync with each other is because how the liquidity pools are bonded. So you might have ETH and wrap Bitcoin in a liquidity pool. So those are going to move together because they're bonded together. So if you're not paying attention to the crypto market in addition to the RWA market, you're going to be in a world of trouble because these things are going to be now interconnected. And so as you see cascading effects in the crypto market, if these on-chain assets are there as well, I mean, it could be a benefit, but there is going to be impact across anything on-chain.
But if you're in a truly free market, right, and let's assume yield-bearing assets, RWA, a certain class of RWAs, which is yield-bearing, or even precious metals, if that bonding does occur, wouldn't that present arbitrage opportunities that the market would correct itself? Because if it drops below a certain price, and I can know spot gold is 4,000, but this bonded gold on Paxos or Kinesis gold is dropping below what I can get on spot, that presents arbitrage opportunities, which the market itself should correct.
Yeah, the market would correct it. And that's what I was saying. It could be a net benefit as well, right? So because they're bonded, there is going to be opportunities, but it could go the other way as well, right? So you could have assets that don't do so well on chain, and maybe they do better in traditional finance kind of things. But yeah, that's the opportunity, and paying attention to that is really important, because if you start seeing those kind of opportunities, there's a whole new other world that you can arbitrage those kinds of things, where maybe on the stock market, something's a certain price, the on-chain world, it's a different price, and there's many things that you can do in order to capitalize on those opportunities.
We've seen that even now. We'll be in the trading spaces, and you'll open up any platform, and you'll see the Bitcoin perps price, the futures price, which is trading on leverage. And you won't see the spot price so much, what the actual price of the Bitcoin is. And it's like, wow, the conversation really has shifted this direction. And it's really interesting. I was going to say, I don't know if you two want to jump in on any of these points. If you do, definitely feel free to. Otherwise, there was a point I wanted to bring up, which was you mentioned proof of reserves, which would be nice. And that is a huge reason that people go on chain. And it kind of got me thinking, like, what are some of the green flags, some of the red flags when you're looking at some of these RWA projects? You guys are also in the conversation with your own companies, but you're also speaking with all sorts of them. I'm sure you see them from the C level all the way up to the A+ level. And so I'd love if you guys zoom in on 1 or 2 points that are either green or red flag. We can maybe start down from here. And I'd love to get some of your thoughts on this. You guys are in all these meetings, so.
Well, a key piece is called proof of reserve, is more trust and transparency. What actually is it? Is it audited? Is there a third-party validation verification, whether it's gold, whether it's accompanying a true valuation of the underlying assets? That's a key piece which comes in place for those. And where are those audits available, and how current are they, and who's doing those? Those are key pieces to making sure you've got an underlying asset which can really be real. I feel that's something necessary and something that crypto hopefully will. Group here is not crypto. We call ourselves more like financial engineers with the blockchain piece on it. But the ability to bring that common sense, validation, truth in a transparent manner, including settlements, because you got 2 things. It's not just underlying assets. Most of the platforms aren't doing, their settlement periods aren't instant as well. So you're dealing with a lot of hypothecation within the platforms. Those of you that have traded on those platforms, which I have, and I find out that I feel like I'm back in the exact same U.S. equities markets where, wait a second, the settlement isn't there and they don't have it, and I got to wait 7 days to get the Bitcoin delivered. So that's another growing up that has to happen. Go back to an infrastructure piece, proof of reserves of both the real-world assets themselves, and in what time frame. There's an ability with blockchain to have that reporting time frame even be sped up. There's some really cool things that are happening. Some we'll call it some more analytical AI stuff we've been looking at, where those values can be adjusted faster and quicker, more transparent, back to the same point of the assets, but also the platforms themselves.
So going back to the original question with the green flags and red flags that we're seeing in different conversations. The red flags a year ago were everything was happening behind walled gardens. Everyone wanted to do private chains, and everyone wanted to just build their own little, palace or kingdom of. Everyone was divided into fiefdoms. You had the DApp, which was a digital asset platform by Goldman Sachs. You had Onyx, which is now rebranded to Kinesis, that was building on their own JPMC chain. And you had Franklin Templeton that wanted to do something on their own. This is the original. Fidelity had their own. So everyone kind of was building their own little fiefdoms. And the problem with that was only because they had no way to manage compliance on a public ledger, they were petrified of actually bringing regulated assets into a public ledger. Because what if my wallets get compromised? What if it gets sent to the Lazarus Group in North Korea, and then men in black vans are going to show up to my offices and shut me down because I distributed yield to a known a hacker or terrorist group, right? So that was the fear of bringing it on-chain. Now we're seeing that shift in conversation occur over the last 5 to 6 months, where more and more of these institutional players are actually eager to come and tap the inherent liquidity that's present on the public networks, and actually start distributing in earnest, where even if you're on a on a subnet or on a AVAX private chain, they're coming up with ways where you can route transactions and share liquidity pools between different, typically siloed ecosystems. So that's one of the green flags that I'm starting to see in the market recently. Again, this is CCIP or CCTP from Chainlink, and Circle is a big step forward in the right direction. Same thing with the Chainlink runtime environment. They're making huge strides in order to make this interoperability come true. And I think unification of that liquidity across multiple chains will lead to a significantly larger adoption of blockchain technology. Now, the second part is RWAs are taking the narrative away from, hey, you've got to get your 24-letter keyword, you've got to know command line code in order to find the second wallet when you minted the first CryptoKitties, you actually had to open up MS-DOS or command line in order to actually mint a CryptoKitty. When NFT reached mass adoption, it was, I can just go on OpenSea and buy it with a credit card. Great, right? We're starting to get to that point now where you can actually purchase a digital asset with a passkey. You can connect your bank account through Plaid, through Bridge or Hi-Fi or Zero Hash, one of the many providers, and actually bridge your money across into your brokerage account, which is your RWA brokerage account, and then purchase an asset just like you would on Fidelity or E-Trade. And one thing I always like asking people in panels is, how many of you know TCP or Simple Mail Protocol? You don't. But how many of you send emails every single day? So you don't need to understand the underlying technology. All you need to know is it's better, cheaper, faster than fax, and it makes your life easier. And if it does, you'll adopt. If it doesn't, it's a fad.
We've seen Peter Schiff, you may or may not know him, he's one of the biggest proponents of gold. He's got a huge business, and it's all about gold, investing in gold, and getting people to buy gold, physical gold. And he opens up a couple weeks ago on a big stream. He's going to be tokenizing gold, offering on-chain ability to have it. And the first pushback was like, well, if you guys are promising that the gold is there, what if I trade the thing and 6 seconds later you move all the physical gold? Like, how is that possible? That was one of the things that got my brain thinking of like, okay, what are the green and red flags here that we need to think about? So I love that you brought a couple of those points up.
Yeah, really, really good points. We are dealing with all of these things in-house. We're dealing with the physical asset. They're vaulted, they're independently audited, CCIP, Chainlink, Proof of Reserves, oracles, all of the good stuff that needs to come in, that is coming in. The sophistication now is bringing all of this stuff to life and is creating trust in the industry that really is driving this industry forward. You start to bring in the yield-bearing elements to this, from my space particularly in physical, it's starting to get very, very exciting. So yeah, the green flags, I think, are there. It's a signal that the industry is shifting that way. The technology is there. We've got incredible players. It's becoming a reality. And yeah, that's all I'd add on that.
Yeah, I agree with Jai. I mean, they're doing some really cool stuff with Kinesis because they come from that gold background where you need to have the gold available, the audits, the third-party stuff that you need to do. They're bringing all that professionalism and keeping buttoned up on chain. Now, not everybody's like that. They're doing a fantastic job with that. I think the green flags for me is third-party audits and validations when you have the disconnect between the on-chain world and the off-chain world. The more of that that's available and that you can verify, I think it's a better green flag.
So starting with the red flag, something that I don't know, it's just causing some confusion is all the big corporations, moving into the space and starting their own L1s, which is on the one hand, a great sign for mainstream adoption. But at the same time, I also fear it can lead to a bit more fractionalization. And interoperability has gotten much better, obviously, right? But it's like a great sign of adoption that Stripe is launching their own L1, Tempo, and that will bring trillions of non-crypto liquidity actually onto blockchain rails. So that's super exciting. But yeah, it's like a true challenge to Ethereum and the existing ecosystems. And Circle with USDC has grown up on Ethereum, launching their own L1. So it's going to be some very exciting times on that front. A green flag that I see that I find very, very encouraging is I also run a AI venture fund. We invest in early stage, mostly decentralized AI opportunities. And something we see there, which is super exciting, AI people, Silicon Valley people, which for a long time, crypto was a bit sus to them. They were not touching it. We're it's all speculation, casino stuff. And as they're building out now decentralized AI infrastructure, decentralized compute, cloud networks, etc., they come to a point where they say, well, what payment infrastructure is this going to be actually structured with? And there's barely no other way than to do that, actually, with blockchain-based payment rails and stable coins. And so we see that side, like really super proper AI researchers coming straight from the universities, building these startups, and they are choosing to use blockchain technology. They're choosing to use tokens as the way to raise money in crypto economic incentive structures. And so that's, for me, also an extremely encouraging sign that I see right now,
Yeah, from my perspective, so at Securitize, I'm on the phone all day with different stablecoin issuers. So I'll look at it from that perspective. So a lot of green flags I'm seeing are these stablecoin issuers that want to use products like the BUIDL fund from BlackRock as a reserve asset. So that does a couple things. It gives that stablecoin a level of trust, right? Because now you can see the reserves are with BlackRock, the largest asset manager in the world. And so that right there puts some legitimacy on the stablecoin. It doesn't wipe away all the risks, but at least a big one, which is proof of reserves. And so a lot of these stablecoins on the red flag side think they could do it themselves. So maybe they're buying T-bills themselves, which you can't compare yourself to BlackRock and buying T-bills. They have scale, they have pricing power. You as an individual or a stablecoin issuer with like $5 million in TVL is going to get bad pricing, right? So you got to be careful for if you're looking at stablecoins, because everyone's launching their own stablecoin in addition to their own L1. So you have to be very careful which stablecoins you're actually investing in or buying. And so from my perspective, look at the stablecoins that have products that are legitimate versus the stablecoins that are doing it themselves and maybe it's low cost. So that's how I would position, proof of reserves is look at the issuer behind the stablecoin.
Any final thoughts here on this one? Otherwise, I have like one last one.
Actually, one major green flag that I forgot to mention is the convergence of the yield between DeFi and TradFi. Go back to 2020, you had Ponzonomics like Wonderland, and even if it wasn't straight up Ponzonomics, you had 20, 30, 40, 50, 80% yield APRs. It was like, yeah, it's 80%, that's low, right? Everyone was just in that mindset that getting 100% yield or risk-free rate on these yields was normal in crypto. At the same time, we were going through COVID. The actual Fed rate was, close to zero. It was 2%, 2.99% if you're lucky. Over the last 2 or 3 years, we've seen a convergence of those two rates, where the DeFi yield in crypto, even if you put in the compounding effect of the price increase, like Solana's 7% or 8%, Bitcoin's like 3%, ETH is like 4 or 5%. Even if you put in the compounding of the price increase, with that yield being generated, you're looking at an average of 10 to 12% on roughly stable assets in crypto. If you look at the TradFi sector, you're getting very similar yield numbers, especially if you're going at things like accounts receivable, trade financing, yield-bearing assets, commercial real estate that is being lended out, very similar rates. So that makes the conversation significantly easier, whereas first the TradFi people would balk at the ridiculous rates crypto was offering, and crypto would kind of have their nose up at, 2%, that's measly, that's peasant rates. So now that the two have converged somewhat, you can actually have a robust conversation about, okay, how do we actually bridge these two and create hybrid product structures using TradFi assets on crypto rails and vice versa?
Very nice. Well, I have one last question, which probably could be its own entire conversation. But, and you guys can take it one of two ways here. Well, this will be like the final one. But we've seen President Trump come in and really, really step into crypto. I've never seen quite anything like it. His entire family is in. They have started all sorts of companies. They've taken to the mining world. They're in. And so we still have minimum a few years at the very least. He's also just cracked open the conversation. Is that even possible? We've seen the government take stakes in public companies even. I have never seen anything like this. It is crazy time to be alive. We've seen a lot of push on the institutional side as well. So my question is two-pronged. You can take it whichever way you want. In the last 12 to 18 months, what has been the most impressive or pivotal changes we've seen? If you want to zoom in on that, or if you want to zoom in on what you'd like to see more of or less of. I'd like to get either way. I think works. I just think it's like the most fascinating time to be alive. I have literally never seen anything like it. I never would have predicted that we've seen this kind of behavior, but we have. And so here we are. And so I definitely want to hear from you guys. Maybe we can start again from here, and then we'll wrap around this way. Sorry.
The past couple of years have been very interesting, especially the previous administration, what they did for those that were trying to do new forms of capital formation, specifically in crypto. We had some projects that I was involved in that were dealing with blockchain structures, where the word came down from the administration when we were dealing with filings with the SEC, where they said, our attorney said, tell us why we can't do this. And the answer was, we can't tell you why. It comes from on high. Well, as soon as Trump got in, that flipped, which was great. I've seen a lot. Clarity is important, just in case. Who knows what comes in 3 or 4 years? Those that have been around long enough know that even though statute of limitations and the government they look back 7, 8 years. They have a time frame to look back, and they can decide if you made did you get an exemption letter? Do you have the ability to say, look, here's my get out of jail free card, because now you're saying I can't do it, whereas before you said I could do it. So that's a very important key piece to happen. What's great now is the clarity's there. A lot of things are opening up, and you're seeing a blend between international and domestic, and people are falling in line. I would like to see domestically in the U.S., you still have a lot of issues to happen on the state level. Yes, federal's done some key pieces, but you got to deal with state regulators. So I'm talking with quite a few different politicians on it. This is great from a federal level. How can we tighten that up so we're not dealing with every single state's attorney general, which is an issue. So I think that's got to be a blend that's going to happen, and hopefully there's some clarity around that, not the Clarity Act, but hopefully there's some pieces that allow us to have that continue to push forward for capital formation.
I tend to agree with Matt here. Regulatory clarity is always great. To be honest, me and a lot of other founders that I know personally were either already moved to Dubai or were on the brink of moving to Dubai, because they were like, well, screw this. Even if you do it right, you can spend hundreds of thousands of dollars in lawyer fees just to be told exactly that. Well, yeah, screw you. You can't do it, even though you're following the letter of the law. And when I first started this out in 2020, 2021, we used to call them real asset NFTs, where you would have redemption rights for the underlying physical asset. And when we were tokenizing it, in my simplistic engineering mind, right, not the financial or regulatory mind, it was, well, if I follow all of the letter of the law and regulatory guidances that govern the underlying asset today, and I enforce all of those things on chain, I should be okay, right? Like, logically, that makes sense. But when you actually went out into get a legal opinion, that was not the case, and they wouldn't tell you why that wasn't the case. So I think that flip-flop that's happened within the US markets is actually great, and I think what Trump has been doing with countries like Qatar, like Saudi Arabia, getting those large investments or commitments to invest in US industry, onshoring a lot of our production, including the NVIDIA Blackwell chip or whatever it's called, bringing all of that manufacturing onshore. I think it is going to boost the economy, not necessarily boost jobs, but boost the economy because of AI and automation that's actually coming into the market right now. So I think the regulatory changes are great, but now we need additional sandboxes in this regulatory framework so we can actually have precedents set, right? Because right now, it's open to interpretation. The Genius Act was a step in the right way, but we need to take a page out of the book of things what the Swiss government did or what the UAE government with VARA did, where, yes, here's the guidance, here's a sandbox where the rules are slightly flexible, where it's going to have a lot of oversight, but we're going to give you the flexibility because we need feedback on our rules as well, right? And then champion 1 or 2 or 3 or 4 projects through, and that sets the precedent for the rest of the market of a clear structure to follow, so where startups are not burning capital on lawyer fees or potentially getting indicted.
Yeah, totally. I'm working in sandbox environment right now in Asia, Southeast Asia. It's so two-way. It's brilliant. We've got regulation out of Cayman. It's becoming a nightmare. just the bureaucracy and the innovation can be stifled by regulation, over-regulation. And there's a real risk to the industry being over-regulated. And some of the product and architectural things that you want to do to make, on-chain everything good can be snatched away through over-regulation very, very quickly. And you're forced to then go, okay, you're starting to look between the lines. And again, it becomes a legal nightmare because you've got the regulator, you've got your internal legal, you've got your external counsel, you've got multiple environments, you've got MICA over here, you've got, Clarity Act coming in here. What I am finding, dealing in a global scale, we've got customers in over 150 countries. We deal with multiple regulators, is the US has been a key driver. Trump, he's done an incredible job at really sort of taking off that Operation Choke Point 2.0 that was happening, and we were having a nightmare. You couldn't get the banking, all the banks were turning you away. All of that's off, but now over-regulation seems to be, a tough challenge that we've got to face, and it can only work if they work with us, hand in hand, regulator to company, supporting each other. So.
Yeah, I think that's a great point. Again, when I was in DC, there was a few politicians there, and there's a group called the Satoshi Action Fund, and they help pass legislation at the state level. So there's the state side of things, and there's the federal side of things. They did some game theory, and they essentially said, well, if Trump's the president, this happens. If Kamala's the president, this happens. So let's try to win at the state level. That way, either president wins, then we have some ground that we've made. So it's a really tough battle, and I think one of the things that we found out, even today, even with Trump in office, if you're a fund, you might need a Cayman entity and then a U.S.-based entity. Everyone wants to bring this onshore. You got to pay 2 lawyers, 2 accountants, 2 legal teams, and it's a nightmare, and it costs so much money. So I think the other piece of this is when you talk about the professional services around crypto, like your auditing firms, your legal firms, they're a lot of the groups that are interacting with the regulators and the legislators, and they are not equipped. I can tell you this, that sometimes I'm like, why am I paying you? Every session that I have with these groups, and the amounts are like $2,000, $3,000 an hour, I'm educating them on what is Uniswap, what is Aave, how do you trade something, what's a MetaMask wallet? And then at a certain point, you're just like, wait, so you're going to take this, it's going to be a bad game of telephone, you're going to tell someone else, then you're going to interact with the SEC, and by the time it gets there, you get something like whatever comes out of Elizabeth Warren's mouth, right? And so that's the difficulty we face here. We need some of the top experts to be interacting directly with the legislators, with the regulators, so it makes sense. And then the other piece of this is we need longevity. If Trump's not in office because he can't do a 3rd term, who knows what's going to happen? He has those 2028 hats. But what happens then? There's uncertainty with all of this. So I think we need some stuff that's going to be able to last the test of time, because in a couple years, 2-3 years, we have an anti-crypto kind of White House and the president. What happens then? So we need some confidence from that perspective in order for the industry to grow.
Yeah, I mean, that makes a lot of sense. I'm a lawyer from Switzerland originally, so luckily I didn't have to deal as much with US lawyers so far. And our startup has been subject to European regulation. But yeah, definitely something that I've just seen is that it's the uncertainty that makes everything so difficult, right? And that Operation Choke Point 2.0 has been ended. I think was very beneficial for the space. Something, however, that I think is missing because of that lack of uncertainty and that kind of switching between terms and every 4 years and everything, and of course because the global market orients itself towards the US, right? That is just a fact. I mean, for the entirety of my time in crypto, everybody, they didn't even need to, they weren't even a lawyer, everybody became an expert in US securities law because it did matter some or the other way if you were building a token project, in a tiny town of Europe, that it would eventually apply to you. But while that's on a regulatory side, I think something that's still missing to an extent is And I think we see that in the crypto markets. If you look at the performance of, I don't know, the equities compared to crypto since Trump took over, equities performed better. You made more money in equities than in crypto. And I think that's testament to a little bit also there are better regulatory frameworks still applying to equities than to crypto. Because in crypto, things that have been outlawed in equities trading since decades, are still kind of formal practice. I mean, there's a billion-dollar project called Pump.fun. That's an activity in public markets which would not be legal. And I think what it's killing a little bit is the social contract between the builders and the investors in the space. And we see now big VC funds like A16C advocating, hey, we should implement maybe a self-regulation. Everybody who's building, all the founders should adhere to 4-year lockup period, stuff like that. And I think a reason why we see the crypto big projects actually not perform that well once they actually launch, hyped up VC valuations, couple of billions, they go and then they'll go down, is because of that. The trust is missing. And builders in the crypto space oftentimes don't actually focus on the relevant metrics, because in equities, yes, it's become a bit more casino-esque, but still it matters how much revenue you have, it matters how much profit you have. These are metrics that sometimes in crypto do not matter as much. You can just be unlucky and you're not in the right narrative right now because this is not a cool narrative, although you're killing it from a metrics perspective. And so I think we need to find a way, maybe that's through self-regulation, maybe it's through regulatory guidance, that really, crypto projects can focus more on building great products that have customer value and are not tiered towards just creating a hype or, Twitter metrics, whatever.
Yeah, so I think there's no question this administration has been very, very pro-crypto, right? From your opening comments and everyone on this panel, I think that's pretty clear. From our perspective, we've been regulatory first since the company started about 7-8 years ago. So everything we've done has been under licenses from the SEC. We're a broker-dealer, we're a transfer agent, and so it's been incredibly frustrating up until about a year ago dealing with our administration, the previous administration, because there weren't laws in place, there wasn't guidance. We were basically trying to invent this industry. And so now with the shackles off, you're seeing all this innovation, you're seeing all these crypto companies starting to go public, you're seeing the Clarity Act, the Genius Act. So my previous comment on stablecoins, as an example, everyone now wants to be Genius compliant. And so what does that mean? Well, they come to us for guidance, they go to others, but the point is that now we have some regulatory clarity. And so I think that's really important for the industry. I think we're all going to benefit from that, the consumer as well, and I think there's more coming. I think Congress is just getting started with this. And so we just have to have more voices out there. Some of our CEOs, some of us have seen different panels in Congress where it's crypto panels, in front of the president even. And so there is a large voice out there for continued openness, and we're always going to have regulation, but it has to be friendly. And so that's what we're seeing now, that shift from being antagonistic to more of a friendly, regulatory environment.
Beautiful. This is a fun conversation, guys. Didn't know what to expect, and so I think this was a really fun one. And we actually went down a couple rabbit holes I didn't expect. One thing I will be keeping an eye for is the prediction markets and whether or not they all go on chain. And then also that opens an entire rabbit hole of the ethics conversation and 1,000 other rabbit holes. So unfortunately, we can't get into that today. But I highly recommend, if you guys are not already diving into the world of cryptocurrencies, of Bitcoin, of all the things we've kind of talked about today, it's going to keep getting bigger and bigger. It's going to become more of a thing that is going to become naturally integrated. And we have the dollars, we have all these currencies that are starting to become up in the air of what people are going to use for whatever reason. And so it's just going to keep getting bigger and bigger. I don't know what to expect in the world, but I'm glad we have these people up on stage with us to kind of give us a little bit of a window into what it's like behind the scenes. So thank you all for joining us, and everyone here, thank you so much.